I know we want to look at Alphabet.
Yeah.
And I know we talked prior to the show, was it GOOGL?
Yeah, we want to look at GOOGL, and Alphabet's a little confusing because they have GOOG and GOOGL. Difference is GOOGL is the Class A share, so they come with voting rights, where GOOG is Class C share, no voting rights, but in theory, they're the same in terms of ownership of the cash flows, the earnings, the sales, and things of that nature. But I thought we'd look at GOOGL, the voting shares, because if we were to buy this company, we would buy the voting shares.
Yeah, and we highly recommend if you are going to buy companies, buy the voting shares. Don't buy the non-voting shares because you can really be left out in the cold with that. So
learn that from personal experience.
Yes. That's one thing I love. People say, "How, you've been doing this for over 40 years. Why do you still love doing it?" Because I'm still learning. I mean, things keep changing and learning. It never gets boring. Sometimes you're like, doggone, I wish I knew that, but it just keeps changing, so it keeps you into it. But talking about Google, again, the symbol is GOOGL, the Internet Content Information Industry, only 1% short on it, 81% institutional owned. PE ratio 25 versus 26.9. We do see price of sales 7.8. That is the same as the industry. Price to book value 8.6 versus 52. That's a positive. Price of cash flow 21.7 versus 21, and PEG ratio very good 2.6 versus 17.3. Now over last year their earnings, and I know you're going to talk more about the lawsuit, but hasn't slowed them down. Their earnings over last year were up 34.6%. The industry is up 38.9%, and sales climbed by 13.1% versus 14. The 5-year earnings per share growth estimate for the analyst 9.3 versus 6.6. Here's another one like Apple. They pay a dividend 0.4%. They use 8.6% of their earnings to pay that out. I'm not sure the reason why. Maybe there's put some somewhere else, but 0.4%. You would not be buying this company for the dividend. Taking a look at the balance sheet, current ratio good, 1.9 versus 2.1. Debt to equity, it's only 0.1 versus 0.2. Very low debt with Google. And you think of all the things they've done with Waymo and YouTube. I mean, they've done it just from cash flow, it appears. We do see the net profit margin is very good, 31.1 versus 30.3. Return on equity also good, 31.9 versus 32. Free cash flow. I know you're sitting down, but this number is amazing. $66.7 billion versus $48.6 billion. And we do know they are spending money on AI, but they still have a pretty high cash flow.
Yeah.
So it'd be higher if they weren't spending whatever it is on AI. But, I mean, you got to do some, so they can't not do it.
So let's take a look at Alphabet Google. I think most people call it. The ticker symbol here we're going to look at is GOOGL. Current price here for, again, Alphabet, $235. 52-week range here, $140.53 is the low. The high, $235.76. And I got to say, gosh, I was blown away by the return here on the last 5 years. I didn't think Alphabet had done this well. And we talked about the Mag 7 earlier, and I was like, maybe, Amazon wasn't the worst performing one. Alphabet up 208%, it looks like, over the last 5 years. Pretty crazy.
And, if you looked at that probably just, I don't say 6 months ago, it probably is nowhere near that. Because I think, didn't they get down like 140 in the price about 6 months ago?
What did I say? The 52-week low is 140.53. Nailed the nail on the head there.
Yeah. Wow.
But looking at the valuation for Alphabet here, we go out to December 2026. Estimated earnings per share is $10.62. I mean, that gives us a target sell here of $176.29. So forward PE now is expensive at 22 times earnings. Future earnings, I should say. And I remember when it was at like 140, we talked about, gosh, if it falls a little bit further, maybe we could step in and buy it. But unfortunately, it looks like may have missed the boat there.
And did you say 1057 was your?
1062.
Okay, because I show over here on Stock Rover, they're showing 994.
Interesting.
So maybe.
Is that 2025?
That's 2025, 60 analyst.
Okay, I'm looking at 2026.
Oh, let me go one more time. Let me see here. Oh, I got to move to the right.
Yep.
Screen at 1058. Sorry about that.
Yeah. So yours is still 1058. Mine's 1062. So,
yeah.
I mean, because mine's 994 for 2025. But, I mean, the big news that we got out here from Alphabet was this, antitrust deal, right? They were a monopoly. And it came out that their remedy, so to speak, is they don't have to sell Chrome, which that was the worst case scenario for them potentially. But also, too, they can't sign exclusive partnerships and they have to share data. Now, that exclusive partnership is really referring to Apple at the end of the day. And Apple pays, Google pays Apple $20 billion a year to be that default search engine. And I don't get it. I don't know why they do it. I feel like even though that wasn't a requirement for them to, not do that anymore, I think they should not do that anymore and return that $20 billion potentially to the shareholders.
Or even cut it down as like, look, we're not going to give you $20 billion. We're going to give you $10 billion. I mean, they seem to be in the driver's seat. And again, they did that years ago.
Yeah.
I mean, I know on my phone I have the search for Apple, but then there's a Google button right next to it. You know? So I don't get why they're spending that $20 billion. Maybe we're missing something.
I mean, maybe we're missing something, but I think there's a better avenue than spending $20 billion. And I heard people say they should invest that money in AI instead.
Oh, there you go.
We'll see.